So let's talk about the economy first overall. I think it's fair to say it's doing better than most people thought it would do. Is there any cause for concern it may be overheating, particularly as we see some new policies maybe coming our way?
So I think let's start on the first part of that question. If we were sitting here last year, our team, the research team, Candace's team, had a soft landing, no landing predicted, and a lot of people say, oh, that's very optimistic. And matter of fact, we went from that would have been like a 1% GDP growth rate this quarter, and we're going to have 2.5 or something like that. So we've moved up from abnormally, from positive but low to now higher than trend, higher than average. And so that means the economy is not having a balance, anything. It's just going on this normal growth trend, which is good news. If you think about it becoming overheated, I think all the policies are yet to come in. There's enthusiasm, there's discussion, but everything's still out there until the policies get enacted. Our team, when they look at tariffs, they say, well, if tariffs are offset by better regulation, they'll kind of even each other out. But even given their knowledge of President-elect Trump's policies, they are still predicting next year's a 2.5% GDP growth. They predict the Fed cuts rates a few times, but stays 3.75 to 4. And they predict it takes inflation all the way into 26 to get down to the target. If the inflation's moving down and we can grow this economy, that's actually not a bad place to be, honestly.
Does this economy need any fiscal stimulus at this point? And it looks right now like the so-called Trump tax cuts will get extended. And also, candidate Trump is talking about a lot more tax cuts. And given the fact that we're above a trend on growth and we're close to full employment, do we need any more stimulus?
I'm not sure you need more stimulus, just like we didn't need the stimulus probably in 21 because the pandemic goes through the system. But the question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are. And that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. And he's a markets-oriented person. He knows that if it gets too far out of line, we just ran for the last fiscal year in the United States an operating deficit of $1.8 trillion. Which is equal to the entire GDP of the country of Australia. And so we got to realize that the impact we have if we don't get this debt back in line. So I think everything on one side has to be governed with whether to do on the other side to offset it and whether it has that much effect. Right now, the economy is moving along. Consumers are spending. It's up for a 2-week period around the holiday, Thanksgiving holiday. It's up 5% over last year. That is good and solid. That is not overheated at all. But that came off the lows a little bit this summer, where I was a little nervous that they were going to let the consumer drift too far down. So between interest rates being cut a little bit, between the enthusiasm around the election, the markets being up, the consumers are spending more and telling us they're going to spend more for the holidays, which is good for the general economy. We got to keep them in the game not by overstimulating, by overdoing, by keeping the game just by getting a good core economy going with good deregulation activities, good tax policy, good immigration policy. These are hard things, but I think they're off working on it.
Let's stay on the consumers here, because you know so much about the consumers here at Bank of America, given your relationships. How is the consumer doing? I know they're spending, but I've seen numbers that suggest they're borrowing more. And in fact, St. Louis Fed has new numbers out from as of October. The defaults are up as well. Are you worried at all about the consumer?
So this is go back to what you're thinking about, which is if you say the levels of consumer credit card debt are above where they were in 19, it's 5 years later. They should be above where they are in 19 because the economy is 30% bigger. So a lot of these novel numbers forget to put them in relative scale. If you look at it on a relative basis, it's still far below where it was in 19. And the credit was very good then. If you look at the defaults, they picked up a normalized defaults and delinquencies to where they were in 19. 2019 was a 50-year low in credit costs in our company. 50 years we had to go back to find. So we got to be a little careful about what we're comparing to. Everything's steady and fine now. Credit quality consumers, their ability to borrow, the household income, they feel a pinch of higher prices. Part of that is real, and part of that's just mental. If the price of eggs doubled, it's hard to ever tell anybody it's okay because they have more wages. They're just never going to agree with us, and that's the economist's view of an economy versus human beings' view. But all things, if they wouldn't be spending money the way they are in a rational way at 5% year over year for the last couple of weeks, 3.5%, 4% for the month of November, and likewise it looks like that'll be December, if they didn't feel confident. And why is that? All comes back to one thing: 4.1% unemployment rate, wage growth of 3%. That's the core. Now, what could disrupt that? A lot of things, but right now that's the condition of the American consumer. They have the ability to borrow, and they're borrowing rationally. They are employed. Their wages are going up. They feel the pinch of inflation. They're trying to work that all through, and they're trying to have a good holiday season. So we'll play that out. What will hurt that worse is unemployment moving up, and right now that's not projected to happen at all next year. It's supposed to go Our team has it 4.3 at year end next year. You and I have been, for most of our business careers, we'd been jumping over this, the moon if we thought unemployment was 4.3 for 2 or 3 years in a row or less.
Take all of that economic data, put it all together, and tell me what the Fed should be doing. They're meeting today. We'll get a decision tomorrow. 25 basis points seems to be baked in as a cut. But should it be cutting further beyond that 25 basis points, given the strength of the economy and all the things you just said?
If the economist's view is you have to have a real rate structure across the curve of 75 basis points, 100 basis points, if you're 475, 450 now, and the inflation rate's 3.3, that's bigger. So you got to start to bring it in normalized. We got to get to, positive sloping curve, a curve that has real rates across it. An inverted curve means something anticipatory is going to go the other way. All that's got to happen. So I think they need to bring it down a little bit. They just have to be more careful because the economy is stronger than we thought 3 months ago, 6 months ago, but it still has potential weaknesses. You and I haven't even talked about what's going on outside the United States that could affect the United States. Not tariffs and stuff, but wars. What happened in the Middle East the week, what happened in Korea, what's happened in Germany. All these political changes could impact the United States ultimately and reverberate with them because we sell a lot of goods in a lot of these countries. And by the way, we buy a lot of stuff from these countries. And so, we're inextricably linked with the outcomes of some of these things. And so we have to be careful. But if you look at it in the U.S., they ought to cut rates, bring them, our team's view is they bring them down to 375-ish type of level, 3 more cuts from where they are today. But they'll be higher in the current context. But if you look back, excluding 2008 till now, a 3.5%, 3% Fed funds rate is the norm, not the exception. It's only been the exception in the last 15 years.
But it is different from what we thought it was going to be. It's higher, I think. The neutral rate's higher than it was. How does that affect your business, if at all? Well,
the question of, everybody says the higher rates help higher rates. The question is why they're there. If we had a normal rate curve from, say, 3.5% on the front end to 4.5% at the 10-year, and the economy was growing at 2%, that's a very good place for banking. Delinquencies would be low, cost of credit and its availability is there. Our deposits are better suited at a higher nominal rate because when they go down, we have 0 floors on a third to half of our deposits that just can't go any lower than 0 unless we start charging people to give us their money, which isn't going to happen. So it's better for us. But if the reason why they're higher is to choke off inflation, that can be not so good because that will probably lead to recession. So the question of what's the underlying economy doing less than the rate structure. And the underlying economy right now growing at 2.5 with a 3.5 to 4% Fed funds rate and a 4.5% 10-year rate would be great for our industry. And that's why NII just keeps growing every quarter. We were at 13.9, 14.1, 14.3, and you expect that growth to continue. And it's just walking up a ladder back to a level, and that peak we were at like 14.8 or 15. So
we have people out right now saying not 4.5, maybe 5% or even 6% on the 10-year. Do you put any credence in that?
Our team doesn't see that, and I have to rely on the experts that spent. We wrote a research paper with a 5,000-year interest rate low in interest rates, and I said, "How do you know that?" And they said, "Well, we went back and did research." So we have Candace's team's a powerful team and the best in the business. So they think it's 4.5-ish is kind of where it is, and as the rate structure comes in. Is there potential for that? Yeah, that's probably when something else is going on that is not good, and therefore there'll be faster adjustments which might bring it back in. But you think about it, to go from a 1.5% 10-year to a 4.5% 10-year, that's a lot of movement, and it's very restrictive on activity till the activity adjusts out of that, and that's what we're seeing now.
You mentioned Donald Trump returning to the presidency next month now. How do you take that into account at Bank of America? I mean, what do you anticipate? We don't know exactly what will happen, when it will happen. So how do you plan for that? What will it mean for Bank of America, do you think?
Well, so I think one of the larger contexts is the oldest part of our company has been around for every presidential transition except for George Washington. So we've been through this before, we'll be through it again. But the real fact of the matter is, if you think about what the policies are that President-elect Trump got elected on, it's inflation and immigration stuff, but it's also about deregulation. And our industry needs to have a sober look at what the right regulation. 15 years ago, 16, 17 years ago, after the financial crisis, we had to put new capital, new liquidity, and restore the confidence of Americans. Since 10, 12 years ago, the capital is about right in the industry, yet we kept ratcheting it up. When we ratchet up capital, that draws down our ability to lend. It makes credit harder to get and more expensive. And on a worldwide competitive basis, our capital ratios are much higher. And then the day-to-day supervision. So the idea of bringing that regulation back in the middle, and then, frankly, for the good of the industry, getting it settled someplace so that we can build a model around it. What happens now is we do this. And so we're hoping it brings it back to the middle. That's what and by the way, that's what our customers like about their industry. So whether it's the FDA, FTC, getting deals done, the enthusiasm, it's all about, wait a second, now we can swing it back to the middle and go get stuff done and make the private sector, which is the reason why America's successful, lead as opposed to the governmental sector.
So when you hear about a pledge for deregulation, is the main thing you hear with your Bank of America ears on is the reserve requirements?
Capital reserve, liquidity, CCAR, there's 1,000 different things. What I really hear about deregulation is our clients also saying, let's do deals, including our banking client. We have our investment banking bank clients, and you've seen 4 or 5 deals passed. The other day, the selling company in a transaction won't sell if there's a lot of uncertainty around it. No matter what the value is, if I don't think it's going to get done, I don't sell. That's what was going on for the last few years. Any deal of size was going to get hung up somehow, unless it was so different. It was like a private equity firm buying a company had no other firm. And that's not good for letting these American companies get more successful and grow. It doesn't mean you're going to be anti-competitive. It doesn't mean you're going to have that. There's huge price desire to market. There's great competition, all that stuff. What it means is our companies can grow and make the kind of strategic choices. That happens in the banking system. We can't do any acquisitions, but it happens to our clients. It happens around us. That'll be good for us. But in ours, it is about capital liquidity and day-to-day supervision.
What is the biggest change coming up for Bank of America because of this new administration, do you think?
I think it'll be the economic atmosphere of deregulation, how it applies to us specifically, how it applies more generally. And that will be good. Now, we got serious issues, as I said, around the outside world. We got serious issues of what the right balance to get the debt back in line with our GDP and keep it there. But those issues are not new, but they have to be dealt with because we've been, in some ways, not dealing with the debt issues or not dealing with immigration since I've been CEO. We've been talking about solutions here. And we got to now start to implement some of those to just bend the curve of debt growth, get more and more cash in to cash out as more rational position, and then and hopefully if you get the regulatory policies, you outgrow that. And that's basically what our research team thinks. They've added a little bit to their growth since saying that combination of policies. Some offset each other, some will add to it, but in the end of the day, it'll be a little bit more growth oriented. We'll see what happens.